valuation ratios and how to use them high. This is your host, and this is a new episode. Today we're going to discuss the most common valuation ratios, how to use them, and more importantly, when not to use them. Let's start with a simple example. You want to invest in Netflix, but first you need to understand if it's fairly valued. First, we can look at its trailing PE ratio, which is its share price divided by its earnings per share. For this video, we will be using TTM or TTM data, which stands for tick to my or trailing 12 months. We have the price-to-book ratio, which is calculated by dividing the stock's price by its book value per share. Its book value per share can be found on the company's balance sheet under the equity section. The free cash flow yield is calculated by dividing the free cash flow per share by the stock's price. There are also some advanced valuation methods that we can use, like discounted cash flow or DCF analysis, but this technique is quite complex and outside the scope of this video. Instead, we'll cover it in a separate video on cash flow statement analysis. Some examples include insider buying, share repurchases, increasing or decreasing profit margins, new patents, competitive moats, increasing debt levels, and undiscovered small caps. You can use these factors to form a comprehensive investment thesis. And it's important to conduct thorough research and due diligence before making any investment decisions. In order to calculate the free cash flow, we can start with the company's net income and add back non-cash expenses like depreciation and amortization. We then subtract capital expenditures, which are investments in property, plant, and equipment. For Pfizer, its PE ratio is 9.8, compared to the pharma industry average of 15.2. Its FCF yield is 1.9%, which is below our 7 threshold. Check out the links below for more resources on valuation. Thanks for watching, and until next time, happy investing. And its PEG ratio is 2.3. Tesla's gross profit margin has been consistently declining, which could be concerning. Additionally, its debt to equity is high at 1.37. Looking at its future prospects, its EPS's growth rate is slowing down, which is reflected in its PEG ratio of 2.3. Its FCF yield is 8.1%, which is higher than the 7% threshold we set. And its PEG ratio is 1.2. Looking at its 1OK, we can see that its gross profit margin is consistently expanding, indicating strong pricing power. Furthermore, its long-term debt to equity is well below 1, suggesting a healthy financial position. One key catalyst for Pfizer is the upcoming Q3 2025 data for its new obesity drug, tirzepatide, which could potentially boost its sales and earnings. The first step would be to screen for undervalued stocks using a screener like FinViz or TradingView. Here's an example of a simple screen. You want to find stocks with a PE ratio that is below the industry average, a PEG ratio that is below 1.0, and a free cash flow yield that is above 7%. The next step would be to perform a qualitative deep dive by reading their 1OK reports. Ask yourself questions such as, are their profit margins expanding or contracting? Is their debt levels manageable? And are they facing any regulatory issues? You can also check the news to see if there are any recent developments or catalysts that could affect the company's stock price. For example, positive news such as new product launches or successful clinical trials could indicate a positive catalyst, whereas negative news such as regulatory setbacks or product recalls could suggest a potential downside risk. Additionally, it's helpful to compare the company's valuation ranges on a historical basis. For instance, we can look at its 5-year low on a PE/PB or PS ratio to gauge if the stock price has declined significantly from its historical average. Lastly, we can ask ourselves if there are any upcoming events that could cause a re-rating in the stock price. These catalysts could include quarterly earnings report, Fed decisions, new product cycles, or seasonal tailwinds. Finally, we subtract the change in working capital, which is the change in current assets and current liabilities. After performing these steps, we get a free cash flow of $4.3 billion. If we divide this number by the number of shares outstanding, we get the free cash flow per share. And lastly, if we divide the free cash flow per share by the stock price, we get the free cash flow yield of 0.14. This number tells us that for every dollar invested in Netflix stock, we only receive a cash flow yield of 14 cents, which does not seem very attractive given that a 10-year U.S. Treasury bond currently yields 4.8. In general, analysts tend to focus on companies with an FCF yield greater than 10, but keep in mind that this number is not perfect, since it depends on the accuracy of the free cash flow calculation. You sum up all the items under the equity section and divide it by the total number of shares outstanding. We can see that Netflix trades at a P/B ratio of 7.8, which is substantially above its industry average of 4.1. Another valuation method you can use is the dividend yield plus the payout ratio. The dividend yield is simply the annual dividend per share divided by the stock's price. The payout ratio is calculated by dividing the dividend per share by the earnings per share. By comparing the dividend yield of a company to its industry average, we can see if the company is offering a higher or lower return to its shareholders. We can also compare its payout ratio to its industry to see if it is sustainable. For Netflix, its yield is 0.34%, which is substantially lower than its industry average of 1.75%, and its payout ratio is less than 10%, which is relatively safe. However, the fact that its yield is so low means that it is unlikely to attract income investors, which could potentially explain why it is trading at a lower valuation than some of its peers. So a trailing P/E ratio simply means take the last 12 months of earnings and divide by the current share price. Now we can compare this number to the broader market, or specifically the sector. Looking at its industry median P/E ratio, we can see that Netflix currently trades at a P/E ratio that is slightly above its industry. We can also look at the historical perspective of Netflix's P/E ratio. Now, the light blue line represents its current P/E ratio throughout the years, and the gray line represents its 5-year average P/E ratio. From this chart, we can see that Netflix currently trades at a lower P/E ratio than its 5-year average, which implies that it is potentially undervalued. However, just looking at these numbers, we don't know anything about the company's future outlook and whether its earnings are expected to go up or down. This is where the PEG ratio comes in, or valuation ratios. The PEG ratio is just a modification of the P/E ratio that takes into account the company's future growth. If a company is growing at 20% per year, then it should naturally command a higher P/E ratio compared to a mature company that is only growing at 2% per year. To calculate the P/E ratio, we simply divide the P/E ratio by the company's annual earnings growth rate. From this chart, we can see that Netflix has been growing its EPS at a pretty consistent rate of around 15 to 20%. We can even get more detailed and look at its quarterly earnings growth rates, or valuation methods. Moving on, let's look at some other popular or valuation ratios, or valuation methodologies. Finally, let's look at one more valuation method, the free cash flow yield. So far, we have covered 4 or valuation ratios, namely the P/E ratio, P ratio, P/B ratio, and the free cash flow yield. Red flags and green lights apart from quantitative analysis. There are also some qualitative red flags and green lights that can help determine whether a stock is undervalued or overvalued. It's putting it all together. A practical workflow. Let's put everything together and see how we can approach a practical workflow for valuing stocks. Real-world example, let's look at 2 companies, Pfizer and Tesla, and see if they meet our criteria for being undervalued. Now let's look at Tesla. Its P/E ratio is 70 compared to the auto industry average of 12. If you enjoyed this video, make sure to hit the like button and subscribe for more investment insights.